afternoon, everybody. I'm Stacy Scott, the Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'm also your host for today. We host our monthly Lunch and Learn at noon on the last Wednesday of every month, and we're so glad that you're here to join us today. We're continuing our series on the 5 steps of wealth management and specifically risk management today, and we're going to be focusing on health insurance considerations. Graham and Jeremy are going to be discussing pre and post age 65 options, as well as going over some important dates for open enrollment. And they'll also be answering questions at the end of this session. So if you have any questions, please get those into the Q&A section of the chat box, and I'll make sure that they can answer those for you. Also, just a reminder, you're going to see Graham's calendar pop up periodically throughout the session. So if you would like to schedule some time with Graham or another member of the team, please don't hesitate to just click on that calendar and select the day and time that works best for you, and we'll get that scheduled. And now, without further ado, I'm going to turn this over to Graham and Jeremy. Guys?
Super. Thank you, Stacy. Jeremy, I'll go ahead and jump in on my part, and then I'll introduce you and bring you on to kind of wrap the call up. But first off, I wanted to thank everyone for being on the call, because the topics that we cover are so important. And Stacy brought up wealth management. Wealth management is more than investments, right? I know this, I probably sound like a broken record at this point, but it needs to be fortified in terms of how we think about managing our wealth through all stages of our life. So we think about 5 different steps of wealth management. So in that, we're thinking about retirement planning. All right, now we're thinking about retirement 2, 3 years, 4 years out. What does it look like in retirement? How do we plan? What are our income sources? Where do we position our assets? Let's say through a distribution model to fund our retirement, or we set things up in a bucket. Again, that's retirement planning. Investment planning, how do you position investments in a diversified portfolio, managing risk and reward for your needs down the road. Then we think about risk management. That's where we're going to kind of wrap up wealth management for this year with risk management, talking about health insurance. Estate planning, how do you pass on or how do you control what's important to you while you're alive and after you pass away? And don't we want good, positive control on the assets that we work so hard for, and taking care of the ones and the things we care about? Last but not least, tax strategy. How do you keep more of what you worked hard for? Remember, it's your legal obligation to pay taxes, but you don't have to pay more taxes than you need to pay, right? So when we think about strategies, how to defer, how to have tax-free growth within your investments over time. So wealth management is more than investments. That's really the culture that we have here at Wickham. So we want to think about the 5 different steps. And today, we're kind of just drilling down on kind of one of our last ones, and that's health insurance. So under risk management, you think about risk management, you want to think about what is your personal coverage, right? What is your home, your auto? Let's make sure the limits are in place. Do you need some ancillary products like an umbrella that will give you limits above and beyond the coverage at your home? And the reason why we're thinking about risk management in the terms of, in this situation, insurance, because we want to mitigate loss, right? We want to pass on some of that financial loss maybe to an insuring company, so you don't have to take it all on, and that would possibly derail you from reaching your retirement planning goals or other expected expenses like college or paying for the mortgage and different things like that. Business insurance or commercial coverage be like workers' comp, general liability. So we want to make sure the personal limits are complementary to your business and vice versa. Think about life insurance. Life insurance can be more than just paying out a death benefit. It can be used as income. It could be a college funding. Again, it can be used for income and retirement. There's so many different facets, that you can use life insurance for. Also, let's say, sort of passing on a business. From a buy-sell agreement, a key man coverage. I mean, again, there's so many options it's too much to go over in this one call. We also spent some time talking about annuities, where we're talking about what are annuities? Annuities are insurance policies designed to pay out an income stream you can't outlive. Now, you can position those to lower risk, maybe pay you out a contractual guarantee income like Social Security or pension that you can rely on. I know for a lot of our clients, or yourself, it could be peace of mind knowing that all your fixed expenses are covered and it's guaranteed, so you don't have to worry about the ebb and flow and the drama of the investment markets, right? We think about disability and coverage that replaces the income while you're employed, right? And long-term care. Long-term care is the need for care, again, for the long term, because it's not a short-term condition that you're going to be recovering from. We spent some time covering that and the cost. The cost is astronomical. You might have some experience with family or loved ones or friends that have gone through a long-term care situation. The cost to cover that can be quite extensive. Now, but let's drill in on health insurance, right? So we're going to talk a little bit about pre-retirement. Basically, what are the coverages? And then what do you want to consider, say, post-retirement or 65? Right? Because you can still have a major medical plan at 65, but the odds are you're probably going to be converting over to what's called Medicare. All right. So let's go ahead and jump in a little more detail on these. And keep in mind, we're going to keep this pretty high level. We just don't have time to get into all the nitty gritty. So as Stacy mentioned, hit our calendar. I'm happy to kind of add some additional details on anything we cover today or any one of my team members on topics that we're going to go over. But let's think about your time frame. So pre-retirement, before 65, you're thinking about your traditional health insurance, major medical plans you might get from the employer, or you go out and you get your own standalone policy. You're probably going to have disability. Why? Because that's when you're looking to replace that paycheck. If you're hurt on the job, that's going to come under a workers' comp. If it's not an accident that happened on the job and it comes under workers' comp, maybe it's a standalone through a private company disability policy. Then let's think we move into 65. So 65 plus, we're thinking about Medicare coverage. Dropping that major medical that you had earlier in life, you're picking up Medicare Part A and B, or some ancillary product like Medicare Advantage, and I'll go over that in more details. Probably disability is probably going to drop off at that particular time, and your mind's going to be thinking about, or it should be thinking about, what if a long-term care situation arises? How am I going to pay for that? That's where long-term care coverage could step in. And then we talk about, that's where a medical supplement policy, Medigap, it kind of fills the gaps, if you might, on what's not covered for Part A and B. But let's drill into this a little bit more. So here we're going to hit it from a high level. Let's think about metals in terms of health insurance. So health plans are organized by the levels of benefits that they offer, right? So platinum being the highest, right? Let's say it's going to cover 90% of the cost, all right? And then after you meet a certain deductible or max out of pocket, they're going to pick up 100% out of that. It's probably going to be your most costly because they cover the most, right? If we think about gold, think about 80, 70 for silver, and bronze being 60%. Think about it, you're going to come out of your pocket more. It's going to be the least expensive, but again, you come out of your pocket a bit more. If we go into kind of each insurance brand is going to have, kind of their own type, if you might. But we want to think about the 4 common types of plans that are generally out there. So when I said brands, you might be talking about Aetna, Blue Cross Blue Shield, United Healthcare, so on and so forth, right? They may have an HMO, or they may have a PPO or a POS option, or even a high deductible option. But they might focus on some areas, like Kaiser Permanente, for example, might focus on HMO. So HMO is going to be maybe a confined network of providers. It's going to be less flexible for you. Maybe you need a referral from the doctor to go to a specialist outside of the designated network. PPO is going to give you a bit more flexibility than an HMO. But again, you might have a little higher out-of-pocket cost if you see network doctors. Then you got to get into a POS plan or a point of service plan. Point of service blend, it's kind of a blend between an HMO and a PPO. Moderate amount of paperwork that would be needed in that situation. And your primary care doctor who coordinates your care may refer you to a specialist. So it kind of has a kind of a hybrid approach between the PPO, right, preferred provider organization, or the HMO, the health maintenance organizations. Last but not least, we get into what's called high deductible health plans. All right, so they might be under a HMO or a PPO or a POS type health plan, but what it is that basically you're incurring more of the cost to have lower cost for that coverage, right? So let's think about it. If you're younger, under 30, for example, you might go with a high deductible plan because you're young, hopefully healthier. You're not really needing all the added benefits of the latter three, right? So you go with a high deductible plan, you incur more of the cost up front, and you can keep your premium cost on a monthly basis down. But there is one interesting additional add-on to that. If you have a high deductible health plan, you can open up a health savings account. All right, so let's go into that in just a little more detail. So let's think about health savings account. Now, it's a type of a savings account that lets you set aside money on a pre-tax basis. Think about that, pre-tax, to cover some of the cost of the high deductible health plan that you have in place. So you got to have the high deductible health plan in place. Then you can open up an HSA, health savings account. Balances are not subject to use it or lose it, so you can carry it to the next year. You may have opportunities to save for those medical expenses, so it needs to be used for medical expenses, right? After 65, I think the plans will allow you to use it for retirement, not just health needs. Most employers will contribute on your behalf to that. So you might want to ask your employer, do they contribute to a health savings account if you have a high deductible healthcare plan in place. Convenient vehicle to save for out-of-pocket expenses, right? The money that you put into this, let's think about it, will grow tax-free, used for qualified medical expenses. The contributions, the earnings, the withdrawals are tax-free. So if we think about your contribution limits to 2022 on a high deductible health plan, they're about $3,600 for individual, basically double that for a family, roughly around $7,300. So you can put in a pretty good amount, carry it forward to cover that higher deductible that you have in place, maybe the co-pays, some of the ancillary costs. Now, it's not going to be used to help cover your premiums. That's going to be out of your pocket, okay? The money that you're putting into these plans, the health savings account, is covering the deductibles, the co-pays, any other ancillary expense under that high deductible plan for your medical needs. So now we're kind of moving forward, right, on the timeline. We've talked all the way, very generally, I know, about health insurance that you might be getting before 65. Now let's jump in at 65 plus. What type of coverage are you going to be thinking about? So if we think about your 65, you're going to probably go in one of two main areas, right? You're probably going to pick up at 65 Part A and B, right? And think about it, if you pick up Part A and B, then you might have to pick up Part D, a prescription drug plan, all right? Also, if you pick up Part A and B, you pick up Part D, then you're probably going to go ahead and get a medical supplement, right? A Medigap plan that picks up or fills in the gaps that A and B doesn't cover. But at the same time, if you're kind of like, hey, I don't want to a la carte this, I want to have something that's all together, then you might want to consider a Medicare Advantage plan, all right? Cost could be a bit higher, but you're not going to have A and B anymore. It's going to be a part of that Part C covers the Medicare Advantage. So will the drugs, and I'll get into a couple more details. Hey, Jeremy, I think if you're still there, can you give me a statement on what is the time frame for Medicare, when you can sign up for it, so on and so forth?
Sure. Thanks, Graham. Yeah, so the initial enrollment period for signing up for Medicare is actually 7 months long. So you get 3 months prior to you turning 65. You get the birth month that you turn 65, and you get 3 months after your birthday month. So you get 7 months total under the initial enrollment period to sign up for A and B. If for some reason you don't hit that 7-month period, you can only enroll every year from January 1 to March 31st. Then you can enroll in that. But the longer you wait, there could be premiums could be higher, and then there also could be some penalties for not signing up during that initial enrollment period. So you get 7 months, 3 months prior, the birth month, and then 3 months after for that.
Okay, great. Thank you, Jeremy. Make sure you stay with us because I'm going to let you cover a bit more of these timelines and things to consider in just a minute. Again, my calendar is popping up, so feel free to hit that. If you want to talk to Jeremy, myself, or any one of my other team members, we're here for you to answer any questions as we go through this. So now, we talked about Medicare, right? So Medicare is a government subsidized health plan. It's available to qualified Americans 65 or older, right? And I touched on Medicare Advantage. So if you grab Medicare, remember you're going to take A, B, you might get the prescription drug plan, and then possibly get a Medigap that I'll cover in a second. Or you can go with the Medicare Advantage. So Medicare Advantage plan is through a private health insurance company, so it's not through the government. It offers generally the same benefits as Part A and B. So basically, at enrollment, if you have enrolled in A and B and you decide to go with Medicare Advantage, they'll drop you off A and B because A and B is included in Medicare Advantage. And I know sometimes we've gotten a lot of questions on that. It can be a bit confusing to try to think about, what's best for you when. It does offer you more coverage than just A and B because you got to buy its a la carte, right? After Medicare is a la carte. So Medicare Advantage might cover some dental, it might have vision, hearing, prescription drugs. There's a fair amount that's a la carte, a part of that in that plan. So let's say you pick up Medicare and you pick up A and B. So then you're thinking, okay, I want to fill in the gaps, right? So we're going to go with a Medigap or a medical supplement plan. It's also sold through a private company. Many of the same carriers that I mentioned earlier offer that. It helps with some of the healthcare costs like co-pays, co-insurance, your deductibles. But the one thing that Medigap does not cover is long-term care. Right? Vision, dental, it's not a part of that. It's not a part of hearing aids or covering eyeglasses or any private duty nurses. All right. So we want to think about other plans like long-term care to cover for the long-term care need, or if Medicaid, not Medicare, would play a role in that situation. So Medicaid is basically there to cover something that's long-term care in terms of a health need, something that's short-term recovering from. That's where your Medicare would step in. Jeremy, I think if you're up for it, let's go ahead and get you on this call and go into some important dates and considerations here.
Sure. Thanks, Graham. Yes. So for open enrollment every single year, open enrollment starts November 1st of this year, 2022, and it goes through January 15th, 2023. So that's kind of the timeline. If you want to get coverage for effective January 1, you would need to sign up or change your plans by December 15th. So to get January 1 coverage, if you get after December 15th through January 15th, your coverage will be effective February 1 of 2023. So you get you get a month where if you sign up after December 15th, you got a month and you have a month off, through February 1st. So those are the open enrollment dates that could be for an individual that's just getting private insurance, or if you're on a group plan at work, it's the same open enrollment period to change your deductibles, add people, things like that at your plan at work. So I'm sure you probably already got something from your employer that says, hey, open enrollment's coming up. Start looking at it and start making any changes prior to December 15th so you can get that January 1 coverage for open enrollment. So With open enrollment, if you miss those dates that I just discussed, so if it's after January 15th, going forward, you have to qualify. You have to have a qualifying life event to get coverage after that time period. So those qualifying events, there's usually four basic qualifying events. There's loss of health coverage. So that means if you were at a job and you were let go, something like that, that would be loss of coverage. Then you could get, that'd be a qualifying event that you could go out to the market or the ACA market and you could get a plan. That also, if you have a younger child that's been on your plan, your parents, and you got a child that's in college or whatever, and they've turned 26, and they have to come off of your family plan and have to get their own plan, that would be a qualifying event for loss of coverage at that point. Also, changes in household. So that means if you got married during the year, if you got a divorce during the year, if you had a baby that you want to add somebody or adopted a child, that's a change in household, and that's a qualifying event, and you can get coverage outside of those open enrollment dates. Also, for that is changes in residence. So if you move to a different zip code, a different county, things change or whatever, you can possibly, that'd be a qualifying event. Or if you're a student that you were on your parents' plan and you moved away from college, you were away from college and you came back, that'd be a qualifying event and you could get coverage at that point. The other qualifying events, kind of the last one, would be maybe if you were became a U.S. citizen, or for some reason you were incarcerated or something like that and you got out, that'd be a qualifying event and you could get coverage at that point. So those are the kind of the qualifying events. That's the open enrollment dates. And I don't know did you have any other questions for me on that, Graham or Stacy, in terms of the dates?
No, I think you did a great job on that. Do we want to go ahead and open this up for roughly the last 7 to 5 minutes of the call?
Graham, sorry, I had one thing left.
Yeah.
So if you don't have a qualifying event and you miss the open enrollment dates, you can go out to the markets and get short-term health insurance to cover you for the time period, usually up to 1 year, and you can get coverage usually the next day. If you go out to one of the markets and get short-term health insurance, you can get that and cover you up until the next open enrollment period, until the effect January 1 of the next year. So that'd be the last thing. So.
No, great point. Glad you brought that up. Super. Well, let's go ahead, Stacy, and let's open this up to some questions. I think we had some come in from some of our attendees.
Yes, we sure did. First of all, does health insurance cover pre-existing conditions?
Jeremy, you want to jump in on this?
Yes. With pre-existing, they can't deny you for pre-existing conditions through the ACA or the Affordable Care Act. So no, they can't deny you coverage with pre-existing conditions. So.
Okay. Another question that's come in is, do the Medicare and Medi-X rules stay consistent from year to year?
You want to take that, Graham?
I think that's a good question. We'll look into it, and maybe we can get back with you with that answer.
Okay. Why do we have an open enrollment period?
Graham, you may take that.
You're doing an excellent job.
Yeah.
Go ahead.
So with open enrollment, it was created to prevent people that adverse selection, basically. So if the people that are healthy that just don't want to pay for health coverage, but then when they get sick or they need surgery or something like that, want to go out and buy health insurance at that point. So it takes the pool of money if there's a large pool of money and people get sick and they need the insurance companies to pay out, there's a larger pool of money there. So that's kind of why it prevents adverse selection for people just to go and get coverage when they need it.
Okay. And when can you apply for Medicare A and B?
So, Jeremy, I'll jump in on this one. I think we're generally 3 months before your 65th birthday,
Yep.
Right? And then 3 months after,
Mm-hmm.
but within a 7-month time frame.
Correct.
Generally how it works, yeah.
Correct.
Okay. All right. Are all of these plans state specific? So if you move to a new state and you have to find a new carrier, is that going to create an issue?
Jeremy, you want to head this one?
I understand the question, and we might have to get back with you on that. I can double check. I think when you move states, you can. It's a qualifying event. If your company is not, they don't have service here, I think it would be considered a qualifying event. But I can get back with you on that.
That's pretty quick.
Okay, well, with Medicare Advantage plans, do you have to use your own in-network doctors to get the full benefit?
Graham, I'm not sure on that. I'd have to check on that as well. We can look in with some of our sources and find that information out and let them know. So.
Yeah, absolutely. But I think that's a great question. So if we don't have the exact answer, we'll definitely get back with each one of you individually with that answer.
Okay. These are great questions coming in, but I don't see any more coming in right now. If you have a question and you want to get it in for us real quick, we still have a couple minutes that we can dedicate to these. I mean, this is obviously a topic that a lot of people, it hits home, and with open enrollment coming up, it's definitely timely as well.
I think we did have another question that came in. It says, with the HSAs, is it possible to get multiple HSA accounts if you move from company to company or provider to provider? I'm not sure.
Right. And then I think this statement came back is that they found that they can merge them into one and it makes it easier to manage. So yeah, exactly. Yeah. So yeah. All right. Stacy, is that kind of do it?
I think that's going to do it for us. Thank you so much, guys. Y'all have obviously presented some very valuable information for us today. And also thanks to our viewers for joining us and getting all these questions in. It's always good to have an interactive session like this. Looking ahead to next month, we're already planning our topic, and it's going to be one that you are not going to want to miss. We're talking about tax planning strategies for the end of the year. And by taking time between now and the end of the year to strategize your tax plan, you can prepare for the upcoming tax season. So please make plans to join us on November 30th for that. And also just remember that you can always stay current and get current market updates from Graham every week on our weekly wrap up. And that's typically on a Monday, and we put it on our social media. We also email it out. So tune into those to get the latest and greatest on what's going on in the market. Right. Thanks again for joining us today, and we hope everybody has a great afternoon. See you next time.
Take care.